Hi, hello everyone. Welcome back to my stream. And my name is Ali, and we are currently at season 3, episode 6. And we are working with the options trading strategy at the moment, this season, especially the strategy that's called Wheel. And we are at 6 episode, meaning that for the last 5 episodes, we've done many things already. And especially what we've done so far is we've built a simulator for the strategy before we dive deeper into the execution and losing money. We are starting with the theoretical part over here, and last time what we did is we completely refactored the code base before it's too late. So now we have a signal based system, as you can see here. Like the strategy before was a playing logic, like if written, and it was harder to check all the edge cases and also test it and also add new functionality. Already saw that there's gonna be a huge technical debt and technical burden for this, so that's why we decided to refactor it first. And here you can see we also added the insights part, which basically it is AI generated, of course, based on our signals and metrics. Here it just has different um like a guidance on what's happening in the current strategy and so on. And also we added a state machine here, so you can see now at which state the current strategy is. And we only have two stages now, like either short put or short call, because we um, always sell options regardless of the market condition, because we did not make any changes to the strategy yet. Here is the signal log, basically which signal was fired by which rule and when and with which reason and so on. So here we also improved a little bit the visualization. We added here dots, basically to say like where to show the places where we sell options. Like here you can see we sell it at this price with this strike price, then we sell it at this strike at this price with this strike price. Oh my god, sorry guys. Oh. um and here you can see the square, the red square, meaning that the put was assigned here. So basically we had to, like, since the price drastically dropped here, um below the strike price, we had to execute, and we executed, we assigned it now, for now, because also we were considering one of the options for the future. One of the improvements is to not assign here, to not actually purchase, but also roll it down. But I think it's going to be conditional depending on what's happening with our portfolio and so on. We'll get to that. Meanwhile, I started trading some options manually, and especially this strategy, to feel the strategy, myself. um Pretty interesting. I'm gonna be sharing some insight, or of course I'm gonna be of course I'm gonna be incorporating all my insights here with you guys on my strategy. And I'm currently minus 92%, to be honest, at the dairy bit, but it's okay. It's okay, because like it's just drop. um I managed to actually like earn 2 times before that, so um we'll see. We'll see. Okay, so coming back to our what's planned for today, let's check our to-do list, and we will immediately. So first point on to-do list was to understand. I think I don't have enough uh oxygen again today. Also my nose is closed, so sorry guys. I don't can't control this. So yeah, first of all was to Okay, sorry. So we need to first understand all the metrics and insights that we have right now, run simulations, seek for improvements, and more easier explanations and associations, so we can easily understand this, what's happening, before we make it more complex. And also, here is another task, which is our improvements list. We have here improvements list, which we planned already, and we want to act on them. We have also the plan, how to act, like we implemented the phase 0. We improve the analytics foundation, and then we want to implement the better price model, the core strategy improvements, and some risk management on top of that. But only after we go back and review all this here, because it's very cool to implement new stuff, but also important to understand what's happening here, keep it under control, and so on. So so as you remember here, let's okay, I need to rerun it again. Okay, as you remember here, what we have is different params that we can tune, and then we have a Monte Carlo simulation. Basically, makes like number of random generates number of random charts, and then simulates our strategy on these charts. And the params for the strategy are here, and the params for the market simulation are here. So basically, here we specify at which price we start our price movement. So you can see it's always starting from 2500 here. Then how many days we simulate. So it's like 30 by default. So we only have like this set of days until here. Then we specify the annual volatility here, which is 80%. So I think it's affected like how the price is moving basically. Like let's take a look at the maximum possible chart, 365 with 80 maximum volatility. It looks like this. It goes like from 500 to 205,000. Down minimum, like the minimum possible is 1,400, and the maximum we saw here is 2,800. Let's take a look if we decrease the volatility to 10, for example. Then you can see it's like more moving around the starting price 2,500. So the minimum was actually like just 150 less, and the maximum was just slightly below 100 more than the starting price. With this we can tune like how it realistically it is to the real market price. We can take a look at the spot price of Ethereum here, a daily chart for a year, for example. Yeah, so you can see from the start. Let's take a look. 15th of February. So from here you can see it went down to 1,400 starting from 2,700, and then it went up to the 4,800, which is like crazy. Historical volatility now was 100, so we can easily 100%. I mean, we can easily put it in even to 100 over here, so we can just simulate the current behavior of Ethereum basically. And yeah, you can see here something similar. Okay, so the next one is annual drift. So I think it's like the percentage of we can ask actually our helper, right? Um, use, wow, something new. Effort lets you control thinking intensity for balance, efficiency, and intelligence for hardest tasks. So, review the code base, and we will ask. I'll ask. So let us just do some basic review so it has it in the context. And we will ask about the annual drift, but I think it's like how the market moves within a year. Let's take a look. Like if we may put it 1 year again here, probably we can like put a drift up, so then this chart should move up instead of 1400 minimum. It should be slightly big. If we do annual drifts 100%, then you can see, yes, it's going up. We will put it minus 100%, and it should go down to 0, I guess, or close to it. Yes. So this is like basically at which direction the market moves. So we have 0 here, so I think it's about just having it like moving up and down equally, you know, without any the deviation. Here we have the costs, and this is a risk-free rate, which is basic bid-ask spread and the fee per trade. So I think this is how you calculate the the Black-Scholes, I think, and also it affects the simulation because it also counts the fees during the P&L calculation. Plain market and costs. So here we have the target delta for puts. So basically at which delta we are selling puts. It's a 0.3. It's close enough to the strike price, to the current price. Let's take a look also here at the options. For example, for 4 days, 20th of February, you can see 0.3 put is basically like this one. So it will just sell the put slightly below the current price, which is okay, like, because here we said that we are ready to buy Ethereum for this price, so it's okay. We are earning money along the way. And okay, so we have it here. So yeah, the annual volatility controls price past randomness via geometric Brownian motion, and used directly in Black-Scholes pricing too. And expected annual drift is expected annual return of ETH. So 0% means neutral market, positive is a bullish, negative is bearish. That's what I just told you before. Here we have bid-ask spread, slippage on option premium applied as a haircut, simulates real world feel quality, never sell at a theoretical mid price. And fee per trade is flat fee per trade per contract deducted from a premium on every option sale and from proceeds on every assignment. Appears in events as a gross premium minus fees. Okay. And it did not explain this one. But what about this? Black and Scholes pricing. Um, Risk-free rate percent is the cost section of simulator. Range 0 to 10, default 5%. It's used in two places. Black and Scholes pricing, passed as a risk-free rate in a strategy config, and fed into Black and Scholes calculation. It affects option theoretical values in strike selection. Higher rate, puts are slightly cheaper, calls are slightly more expensive. Um, how do I set it correctly? So let's take a look at the strategy. So here is the target delta for puts. I already explained you that. This is IV premium over RV. I don't remember this. We're gonna have to review this once more again. Cycle length is 7 days, and which is like basically a 7 days contract. So here we have like a weekly contracts. For example, here 20th February, 27th, and 6th of March. So these are the weekly contracts. And here we have daily contracts like for tomorrow, for after tomorrow, and so on. Then the contracts, we usually trade just one. It's enough because it just scales. And then we have adaptive call delta, which is like instead of just fixed delta for puts, we have it running from 0.1 to 0.5 depending on how we are on the market. So it's like here 0.5, you can see it's, oh sorry, yeah, it's the same 0.5, you can see it here, and up to 0.1 here. So if we are already profitable, then we sell the maximum call delta, which is like here. So we are basically earning, like, if we will sell the option like this, you can see we get like 2.5% immediately, and also we have an option to sell. We have an obligation basically to sell if the price goes up, and we are okay because we purchased below that price. So we are exiting the market, we are executing our rights, and so on. So we are okay with that. And if we are not profitable yet, then we don't want to sell like at this price. We can sell at a higher price, and we take like 0.1 delta which is like here basically, and this is 2200. So we will only sell our Ethereum at 2200, which is what we are going to be changing. And there is also skip threshold percent, like this is 0.1% at the moment, which means is like, where is it, here for this price we are not gonna sell it anymore. So we also cap the maximum or the minimum amount of premium we want to in order to sell our option, otherwise we don't consider it. Okay, let's go back to our value. Use the current analyzed yield in the short-term US Treasury, since that's the standard proxy for the risk-free rate. How to check? Search US 3 months. Yeah, let's take a look. 3.7. I don't know if it changes actually much our calculation. Not really. Not really. Doesn't affect much. Okay, let's ask to explain this. So
if you're simulating short-term horizons, 30, 90 days, the exact value matters less. The difference between 4 and 5% is negligible over months. If you are simulating a full year, it has more impact on Sharp's Reno interpretation. The default of 5% is reasonable for the current rate environment. Set it to 0% if you want to see the raw performance without opportunity cost adjustment. Okay, so the next one is the IV premium over RV. This is the strategy section, range from 0 to 50, default to 15. What it models in the real markets, implied volatility, what options are priced at, is almost always higher than the realized volatility, how much the price actually moves. So option sellers profit from this gap. You collect premium based on IV, but experience moves based on RV. How it works: implied volatility is annual volatility multiplied by 1 plus. Okay, so with the defaults 80 annual month volatility and 15 IV premium. The IV will be 92. The price paths are generated using table controls. How to set it: 15% default is a reasonable estimate for each options. Setting to 0 allows to check if the strategy still earns money. Interesting. Okay. So the higher IV premium over RV is basically the more money we make because the premiums are higher. So it only affects premiums, I guess. Okay, now it's cool. Everything is more or less okay over here. Maybe we can add tooltips here. Can you add the tooltips to the strategy, to the items under real strategy and under buy and hold benchmark? I want to be able to hover and read about how the metric, how to read it, what it means, etc. So we will just add a small helper here. Then we're gonna learn how to read insights as well. Doesn't work. Okay, so it's like this. So let's take a look. Here, win rate is the percentage of a simulation runs that ended with positive PNL. Above 50% means the strategy is profitable, more than not. Higher is better. Mean APR is the average analyzed percentage return across all simulation. Positive means the strategy is profitable on average, compared to B and H mean APR to judge if the wheel adds value. Yeah, so you can see here the mean holding is yeah. So the average analyzed return from simply buying and holding is across all simulations. This is your baseline. If the whale can't beat this, you're better off just holding. So we definitely see that it beats here. If we even run like more simulations, like 2000 simulations, always beats here. And the same, I guess, with the PNL. This is the maximum drawdown. So basically, the lowest our portfolio was during the simulation. Lower is better. Are you sure that lower PD value is better? The just checking. Always below 0 and red. Okay. Okay, so it's fixed now. Sharp. Analyze Sharp ratio is risk-adjusted return relative to the risk-free rate. Above 1 is good, above 2 is excellent, measures return per unit of total volatility both up and down. Yeah, so basically we run it for more days. It just increases. But if we run it for more days, but at the same time higher cycle, even worse. We will drift positively. Probably holding should probably be better. Okay, let's go back. This Ortino is like Sharp, but only personalizes downside volatility. Penalizes downside volatility. Above 1 is good, above 2 is excellent, better for strategies with asymmetric returns. It ignores upside variance. Okay, now it's better, and I think Alpha, let's take a look at this one. Express excess return of the wheel over buy and hold means APR minus mean APR minus BHA mean APR. Okay, So just positive alpha means the wheel outperforms. Holding, this is the key metric. It tells you if the strategy adds value beyond the simple exposure. Okay, I think it's all clear now. Let's take a look at the insights and a couple of simulations. I'm afraid this won't take much time for us, but I want to also implement something today. Some improvements, but we need to understand what's improving, So I don't know. Take a look. Yeah, okay, let's spend like, I don't know, 5-10 minutes more for on this, and then maybe can do make it new implementations. So let's take a look here. First insight is a strong risk adjusted returns. So wheel sharp 136 and exceeds the BNH 0 points. Okay, we know how to read that now, which is cool. Significant alpha, yeah, this one we understand. Alpha over buy and hold, yes. Downside well contained. So 1301 for 114 means significantly exceeds the sharp. Premium income is cushioning losses. Weak in bull regimes. Will loses 53% alpha in bull regimes. I think we can. Maybe we can move this up. Yeah, let's move this. Move this and this. Or maybe. Hmm. Or maybe let's make it like this. Can you make insights section 50% of its current width? so half of the page, and the other half on the right, separate by two sections vertically, and place APR and PNL distribution charts smaller charts in there. I think that would be better. So we are gonna just move like hide this by half. We'll cut this by half, and then we will put this distribution chart here and here. So they don't need to be like this big like this, and also the insides are not to be like this huge. And then we will see everything together here. Or we can even maybe move the distribution charts over here. But it looks good. Okay. Okay. So here we see that in bull regimes the whale loses 53% alpha. So you can see here, like if the market goes up, then the holding is better. But if the market goes down, then of course our strategy is good, and sideways is also good. The large average drawdown, average max drawdown $313 exceeds 50% of estimated capital at risk. Consider reducing contracts to limit downside exposure. Okay. Okay, now it's all clear here, I think. So here you can see that on the bull market, we have like 91% win rate on our strategy, but it's also worse anyway than the holding. And you can see here, like on the bear market, it says that it's better than the holding, of course, because the market goes down, but it's like 32% win rate, so it doesn't necessarily mean that we will outperform it, you know. So I mean, we will outperform the like holding, of course, but it's not that we are gonna win anything. More likely we are gonna lose. So on the bear markets, probably we shouldn't be running this. But it also depends. Like we will change the market conditions now, and we will see how this changes as well. And if the market goes sideways, then we are good to go. Like the volatility is our friend here. We are outperforming the holding, and we are also having the win rate almost like 9% as well. I think if we will put the drift here to 100%, then we should have more runs here. Down. State machine is clear. I don't need to repeat that. And here the simulations are the same. Okay, I think we can start implementing our improvements now. We are getting to plan. Plan phase 1 from improvements. .md. So it's gonna implement 4.2 and 4.4. Let's take a look at them. 4.2 is this stochastic volatility model, which is like replace the constant. Oh, okay, yes, that means makes sense, because now we have like a fixed volatility. 80%. That's what we reviewed at the beginning. So this is cool that we reviewed everything at the beginning. Now we can um more sophisticatedly discuss this. Real crypto volatility exhibits these properties would make Monte Carlo results more realistic. Okay, this makes sense. And let's take a look at another one. It's 4.4, which is jump diffusion model. Add a poison jump process to GBM for fat tail events, sudden crashes, pumps, better models tail risk, and give more realistic drawdown estimate. Wow, yes, this is also cool. So we're basically working on right now is also on the simulation itself, not the strategy. Um, yeah, better price model. So here, when we generate this chart, it will now, first of all, not use the constant volatility here, the annual volatility, but it will somehow make it dynamic. Not sure how yet, but we'll ask about it, of course. And also the second one is, if you've seen this 1 year chart, it doesn't have like any huge jumps. And if you will take a look at the spot price of Ethereum here, you can see like over the last year it jumped significantly a couple of times and then it went down. So this is what is going to be simulated there as well. So we have some sudden spikes somewhere here, and this will also bring us more realistic price simulation than what we have right now. That's the point of these two tasks. Every subsequent movements depend on the realistic price path. Test by comparing generated return distributions against historical ETH data. Fat tails, volatility clustering. I think you can do even this second phase as well today. So the first phase we discussed already. The second one is implementation of 2.2, 4.1, 1.1, and 2.1. So let's take a look at them meanwhile. 2.2 is minimum strike at the cost basis. So basically what we discussed before is that never sell a call below the put assignment strike. Guarantees no loss at the stock leg if assigned. Currently, the adaptive delta could theoretically select a strike below entry in crash. So this is what we are gonna do first. Then IV-RV spread signal, now meaningful with stochastic volatility. Yeah. So before it was the same spread because we calculated IV based on RV multiplied by some multiplication that we had here. And it didn't make any sense to have a signal for it because it's constant here. And now that it's gonna be having dynamic stochastic volatility, then the implied volatility will make sense. Compare. Then dynamic delta. Let's take a look. 4.1. I think we have it. When IV is more than RV premiums are reached, sell more aggressively. When IV is equal to RV premiums are all fair. Currently is static. This should be dynamic per cycle. Okay, and next one is dynamic delta. Uses IV-RV spread 1.1. Sell higher delta closer to add the money. Puts when IV is elevated. Reach premiums compensate for risk. And lower delta when IV is low currently uses a fixed target delta. Yeah, it's for puts, I guess. And also the 2.1 roll up out. I think this one will be the most important. Roll up and out instead of assignment. When a call goes in the money before expiration, roll to a higher strike. Further date to expiry for the next net credit. Avoids forced selling and captures more upside. Current simulation just waits for expiry. Yeah, I think these are doable. These are just additional rules, so it should be easy to implement based on our recent refactoring. Okay, let's just start editing it, and we're gonna read the plan because we can adjust it on go. Yeah, I was actually putting more, betting more of myself onto this 2.1 fix. So it's cool that we're gonna implement those. Let's take a look. So the current price generator uses constant volatility, which doesn't capture real crypto behavior, volatility, clustering, mean, reversion, or fat tail events. Every subsequent improvement in improvement MD depends on realistic price paths. This phase replaces the price model foundation. Um, so the price generation, Monte Carlo, and a little bit of simulation and rules will be changed. Okay, makes sense. Factor price gain, interfaces, and GBM extraction. So some simulations, prices Heston, using Anderson model. I'm not sure. I don't know any of these words, like all these names of models and so on. I'm sure it's like something that's taught on financial universities or financial theory, which is what I'm lacking, to be honest. But gotta learn. The most important part is to understand what's happening in general. Getting closer. Documentation is done. Still working on tests. Okay, running tests. Nothing is broken. Wow. Okay, so it's done supposedly. Let me add all the changes to stage. Um, I think we can do it for 1 year and see. Okay, so now you see it goes like sideways much more. For Ethereum over here. Okay, so we have new options here to simulate, but I don't know how to use them. Like it's just more params. I mean, there are four um modes now. One, do I run and how? Okay, the first one, GBM, is constant volatility. Teston is stochastic volatility with mean reversion. Jump is GBM plus pause and jumps. Those combined show all sliders. Okay, so this one I guess supposed to be the more realistic Teston jump. Here. Okay. So how it always goes down. Is it our future? Oh my god. Never recovers. Okay, so the market is bear all the time. Like, what if we go to Heston? It's like 88 to 10 to 100. Jump is 76 to 100. 11. Here is the 77 to 112. To 1 year, normal GBM will be 56 to 109. Teston will be 54 to 106. Jump will be 43. Okay, so if I select GBM, it means nothing new. Also, which one is more realistic? Why simulations generate and of all the time? Okay, the realistic one is Heston jump. Let's go make it 1 year. Let's take a look at the distribution, like 55, 116 here. And what if we make, yeah, it's still the same. The median path drifts downwards. $32. So it offers me to increase the drift to 32. Okay. Now more bullish. Okay, cool. I think we are good to go. This makes sense, and we will need to learn how to use it, but it's correct to me. Let's take a look one more time on 1 year with jumps and without jumps. So this is like straightish jumps. Okay, yeah, let's go. Let's continue. I think Mark. Any updates? Data top. Okay, so all the docs are updated. Take a look. Architecture, simulation. Okay. Okay, looks good. Now let's do next phase. But one by one, so I can test and the, the performance. Okay, so we are gonna implement 2.2 now. Okay, so the context here is the approaches here is gonna be modify adaptive call rule and low premium strike skip rule to clamp the computed strike when a position exists. No new rule needed. This is a behavior change within the existing rules controlled by a config toggle. If clamping pushes the strike up, premium drops. Naturally interacts with low premium skip rule. The only available call has terrible premium, and the skip rule catches it. Okay. Okay, let's go. Okay, so it's done. But I'm not sure yet. Premium strike price is when mean strike price is enabled. Post adaptive rule and low premium skip rule. Clamp the computer call. Um, um, let me clamps. Okay, this prevents selling a call below the ETH entry price. Block and guaranteed loss on the stock leg if assigned. Clamping pushes the strike up. The premium drops. This naturally interacts with low premium skip rule. If the only available call has insufficient premium, the skip rule catches it. Okay, now we see skips here. This is probably the point. And you can see here now it sells at the same price as it buys, and we have also now new state here holding ETH. So we have skips here, skipping later on because we are underwater. Yeah, exactly. You can see now skipping happens when you are underwater and you cannot find any strike that's that pays good. That pays good. And it's still profitable. Yeah, so you can see here, and now it does not sell with the strike prices less than the purchase price. Awesome. 1 year more, one more time. Yep. Okay. Let's make. Okay, let's implement second one. taking longer, even from planning, harder. Compute call delta function currently doesn't receive market. It takes market portfolio config at the rule level, but the helper itself only gets market portfolio config. Wait, actually, it does receive market. Real question. Should RV spread default to on or off? Do I default on? Yeah, I think I overloaded the. Probably should start a new one. Yeah, okay. Already. Okay, so it's done. Um, they- so we have 4 new controllers like this one and these ones. Minimum, maximum multiplayer, and look back. So IV RV spread scaling when enabled delta is automatically adjusted based on how rich option premiums are relative to realized volatility. So I guess it doesn't work with GBM. I guess a new feature doesn't make any impact with GBM because we have the spread stays static in there. The feature becomes meaningful with Heston or Heston jump. Take a look. Now let's refresh again. Let's put custom in here. Turn off, turn on. Maybe let's try 1 year. Yeah, it does a little bit improve. I think not drastically, maybe. Jump. Yeah, okay. Maybe if we tune it better. Um. Okay. So we implemented 2.2 and 4.1 marked here. 2.2. You didn't check in file. Okay. So we had some of the contradictions here, which said that 4.1 and Both modulate aggressiveness based on volatility, but use different signals. IV rank percentile asks, is IV high relative to the own history, while IV red asks if IV high relative to the realized volatility. These can disagree. IV could be at this 90 percentile, but still accurately pricing delta multiplier. Okay. Now that we are done with 2.2 and 4.1, what will be approach for 1. So we previously we analyzed that 1.1 is actually contradicts with the 4.1, and we just implemented 4.1. So I'm wondering how this is gonna be handled. Dynamic data based on delta based on IV rank percentile cell higher delta. Probably doesn't matter much actually. So the current state is the IV RV spread multiplier 4.1 already scales target delta. Oh, okay. 4.1 was above about as well. Okay, it's applied both in put in both base put rule and compute call delta. The key tension IV RV asks is IV reach versus realized, while IV rank asks is IV high versus its own history. These can disagree. IV could be at its 90th percentile, but accurately pricing realized volatility. Conversely, AV could be at its 30th percentile but still overpricing low realized volatility. Can we switch? Let's switch to high effort. Um, what do you think? Answer me first. What do you think the best? Okay, I think the AV-RV spread alone is the stronger signal, and AV rank adds marginal value on top of it. Here is why. IV-RV measures edge. Am I being overpaid for the actual risk? Okay. Um, that's the thing that matters for selling options. When IVRV is 1.5, you're collecting 50% more premium than realized feel avoidable mispricing. IV rank measures absolute level, but high IV doesn't mean premium. IV is at its 90th realized volatility spiked match. You're being fairly compensated, no edge. IV rank would tell you to be aggressive in exactly the wrong situation. IV rank does add something, reversion timing. IV is at its so it's more likely to drop, which benefits short option. But in your stochastic volatility model lesson, IV already mean hurts by fraction, and high VRV ratios tend to hide IV rank anyway, since IV spikes faster than realized volatility. My recommendation, if you still want to implement it, reasonable. It's one more knob for users to experiment with. Keep it simple. Default it off. Okay, we are not gonna implement this one. Okay, mark it as skipped and in the file. And write down the reason and plan 2.1. Or no, we will implement this later because we are at time limit already. Okay, I think that should be enough. And for 2.1, we are gonna implement it later. That was actually my most no, wanted um, improvement, but yeah, let's keep it for the next time and make it more interesting. And let's write it down. So today we understood all the params, which is cool. We are having this as a done, then implement the improvement. So we are going to implement 2.1. No need to mention that here. And maybe we should mark it as a mark it in the main improvements list to okay, so it's marked as a done here, but mentioned that it was skipped. Okay, so we implemented some of the strategy improvements today, and especially these were better price model. So we implemented the stochastic volatility and jump diffusion. So we have now here this Heston jump options to simulate the price movements more realistically, and also we added this 2.2, which is the minimum strike at the cost basis. So now we are not selling the options, the call options, if the strike price is lower than the assigned price for the puts that we were assigned to. So basically we are not losing any money anymore on the price going, like staying below, and we are selling calls in there. So now we never sell calls, and the rest we just check. Like we could have sold here something, but the premium was so low, which it makes no sense to have a risk, and we just sold it. Yeah, so I think the win rate is actually decreased a little bit for our strategy, but this is good because we now understand more what we should and we should not do, because the price is more realistically simulated. So for the next episode, we are gonna be implementing the rolling up for the goals 2.1, and we will see probably risk management as well. Yeah, this is the most important part, but yeah. So that's it. Um, yeah, okay. Um, yeah, so I think we did a great job today. So the last improvements probably is gonna be on the next episode, and after that we will see. What I want to do is analyze manual. Yeah, let's just write it down here as well. Once all improvements are implemented, let's do more rounds on simulations and manually check everything, every trade that made sense, had the proper signal decision, and we see no improvements anymore. Okay. Yeah, so what we're gonna do next time is we're gonna just go by one by one like we did before. We are gonna review every trade, every decision that our system made, and we will check if it made sense and why it did this. So we are like fully again controlling the situation over here, and yeah, here. Yes, and we are gonna check if everything was implemented well. Then we can probably start getting to the next phase of the execution. Also, we still need to implement the um, simulation part here, backtesting. So let me move these tasks already to do. I think we are already here. Can do this. Yeah, so I think that's a good plan. Thanks everyone for joining today as usual. Don't forget to put likes and subscribes. And I also have a Telegram channel where I announce all my streams, and would be glad to see you there. So thank you again for joining me today, and see you on Wednesdays 3 p.m. Central European Time as usual. Bye bye.